Residual risk and return information ratio. What we get to learn in this reading is, first we will look at the key terms, then the meaning of the word alpha in two separate senses, ex post and ex ante, information ratio formula using the T statistic. Then we would have a look at the concept of and calculation of value added. This third point I particularly feel is important from your exam perspective. Then optimum level of residual risk and understanding that a particular active strategy does not depend on investor risk aversion. So these are the 5 main focal points of the reading. Let's go through the important terms. The first term is the meaning of active portfolio management. And active portfolio management simply means that you are taking active bets in your portfolio. Either those bets could be on account of giving weights to particular sector. For example, in index, pharmaceutical sector is 17%, but you as an active portfolio manager decided to take bet of 25 because you felt that the pharmaceutical sector is going to overperform. Or you kept the weight same, but you changed your security selection. Right? So instead of selecting security A, B and C, which are constituents of the index, you said that you will put almost 90% money into security B and maybe 5% into security A and C each. So that is your active portfolio management. In this reading, risk is defined in terms of standard deviation. Okay, so if you see a sentence which says that the returns can increase only at the cost of increased risk, then they are referring to increased standard deviation. Then an important concept of difference between active return and residual return. Now there is a lot of confusion around how an information ratio should be calculated. There are two alternative versions of this. First version of the formula is active return divided by active risk. But as far as CFA Level 2 exams are concerned, they have ignored this particular definition of information ratio formula. The definition that has been used in the reading is residual return divided by residual risk. And therefore for us it is important to be able to distinguish between the meaning of active return and residual return. So in hypothetical scenario, let us say return on portfolio, a particular manager has been able to achieve 30%. Risk-free rate of return is 10%. Return on markets are 15%, which is also the benchmark. And beta of this particular portfolio was 1.5. Then first we will say that a manager has been able to generate a return of 30, whereas the benchmark, which was market in this case, was able to generate return of 15. That means the excess return that manager has been able to generate is how much? 30 minus 15, it is 15%. This excess return over and above benchmark is called as active return. But then we can diagnose further in terms of how we have been able to earn that active return. So we will divide that into two parts. The first part of the active return is beta, and second part or second source of the active return is alpha. So then the first question we will ask ourselves, that market has a beta exposure of 1, but this particular portfolio has taken a beta exposure of 1.5. So because we have taken extra risk, we should earn some extra return. And how much? Because we have taken excess beta exposure of 0.5 into how much do we earn per beta, and the return that we earn per beta is nothing but equity risk premium, which in this case is 15 minus 10, which is 5. So on account of beta, the excess return that we've been able to generate is 2.5%, which means the alpha that we've earned on this security has to be 12.5%, and this alpha is actually called as residual return. Okay, so in this particular example, and in fact for this entire reading, the special case of alpha has been considered, which is nothing but Jensen's alpha that we learned at level 1. And the formula for Jensen's alpha was return on the portfolio minus cost of equity as per the CAPM model. So return on portfolio is 30% minus risk-free rate of return 10% plus beta 1.5 into equity risk premium of 5. So that would be 30% minus 17.5%, which will again give us an alpha of 12.5%. And this alpha is called as the residual return. Let us look at one more example. Let us say return on portfolio is 25%, risk-free rate of return 8%, return on markets 10%, beta of the portfolio is 3. So now tell me, how much is the active return? How much would be the active return here? It would be 15%. The return that we've been able to earn over and above the benchmark. This return we've been able to generate through two sources, beta and alpha. So instead of taking beta of 1, which was the beta of the market, we have taken beta of 3. That means we have taken excess beta of 2, and equity risk premium is 2%. That means on account of beta we've been able to generate 4, which means on account of alpha the return should be 11%. And how would we calculate that? We will say return on portfolio minus the returns to be given as per CAPM. So return on portfolio 25% minus risk-free rate of return, which is 8, plus equity risk premium 2 into 3, that's 6. So 25 minus 14, that would again give us 11%. So this is how residual return are to be calculated, which are going to be different than active return. But if the beta of the portfolio and the beta of benchmark happens to be same, then active return and residual return would be same concept, because there is no exposure towards excess beta. Which means if your benchmark portfolio, assuming that this was benchmark, it had a beta of 3, then we would say that entire 15% is the active return, which is also same as the alpha, because the excess beta would be 0. Are we fine here? Now once you've built an understanding of this concept, then think of a scenario. Let us say we have two portfolio managers, portfolio manager A and portfolio manager B. We are looking at the residual return that these portfolio managers have been able to generate. Okay, so let's look at year 1, year 2, year 3 and year 4. Let's say year 1, portfolio manager A was able to generate 20%, but year 2 he was able to generate 0. Year 3 he was able to generate 30%, but year 4 he had an alpha of minus 10. Whereas portfolio manager B has 11%, 9%, 11% and 9%. Now we decide to calculate an average residual return for these portfolio manager. So what would be an average of this value? Average of these would be 10%. And what would be an average here? So 10%. So from a residual return perspective, both the managers seem to be doing a good job. But then we can clearly see that portfolio manager B seems to be much more consistent than portfolio manager A. And therefore what we would also calculate is the standard deviation of this residual return. So we will calculate standard deviation of these, and standard deviation of this residual return would be called as residual risk. Okay, so let us use your financial calculator and let us see if we can calculate the standard deviation. So put these values in the data function by saying second 7. x1 would be 20, x2 would be 0, x3 would be 30 and x4 would be minus 10. And solve for sigma x. How much is the sigma x? 15.81. And put these values in the x function and solve for sigma x. In fact, it would simply be 1. Isn't it? X minus X bar, all of those would be 1. Then we'll square, which would be 1. Total 4. 4 divided by 4 under root. This standard deviation would be 1. And then using this, we can calculate information ratio. Right? So, an information ratio in the simplest definition would be residual return divided by residual risk. So, for portfolio manager A, that would be calculated as 10 divided by 15.81. And portfolio manager B, it would be 10 divided by 1. And of course we will say that, now this is a very hypothetical scenario, but we will say that portfolio manager B is substantially better than portfolio manager A. Are we doing fine? The next concept, which is active risk and residual risk. So residual risk is simply the standard deviation of residual returns, and active risk would be standard deviation of the active returns. Okay. Now there are different interpretations available of these risks, but again for this particular reading we will confine ourselves to this interpretation, that this is simply the standard deviation of returns, residual return, and active risk would be standard deviation of active returns. Then certain important notations used in the reading. The first one is alpha, and alpha is same as residual return. Next one is beta, which is the slope exposure. Then residual risk in this reading has been denoted by the sign omega, and residual risk aversion parameter would be denoted by a sign lambda. Okay, so at level 1 we have learned the concept of risk averse investor. Risk averse means the one who would, for a given level of additional risk, demand for an incremental return. So then we can have either less risk averse investor, or we can have moderate risk averse investor, or we can have highly risk averse investor. This parameter lambda for a less risk averse investor could be something like 0.05. But then if you are more risk averse, this value will increase. If you are further more risk averse, then the value will increase further. That means higher the risk aversion parameter, more is going to be the risk aversion of the investor. So who is the most aggressive out of the three? If this is A, this is B, this is C, who is most aggressive? A. Right? So aggressive investor will have low risk aversion parameter, but a conservative investor will fall into the last category, who will have really high amount of risk aversion parameter. Are we good to go ahead? So a simple practice question. A manager has been able to achieve a return of 20% on his portfolio with a beta of 1.5. Return on markets which are also the benchmark are 8%, RFR is 5%. Segregate active return source between alpha and beta. So active return in this case is 20 minus 8, which is 12%, which we will say is coming to us because of having exposure to excess beta, and then the residual return. We have an excess beta of 0.5 and equity risk premium is 3. So 3 into 0.5, this would be 1.5, which means alpha should be 10.5. And we could have also cross-checked this by saying return on portfolio minus RFR plus beta into equity risk premium. Return on portfolio is 20%, RFR is 5, this is 3 into 1.5, so that would be 20 minus 9.5, which would be 10.5%. Moving further. Next concept is alpha in the ex post context and ex ante context. Ex post would mean that we are looking at historical alpha, but ex ante would mean that we are looking at a forward looking alpha. That means we are trying to make a forecast for future. Now the thing that you would want to remember for the exams, is that X post alpha could be either positive or it could be negative. Right? Because we are dealing with historical data, so manager could go right or he could go wrong. So we can have a positive or negative X post alpha. But X anti alpha should generally be positive, because if you're an active manager, you would never say that I'm expecting to generate alpha of -3%, isn't it? Then an investor is simply better off investing into benchmark. So X anti alphas would generally be positive. Alpha or residual return is the return of a portfolio in excess of its benchmark. Is this correct? If alpha is the return of the portfolio in excess of benchmark, if the risk of the benchmark and risk of the portfolio is same, that means there is no return on account of beta. So which is written here, adjusted for risk differences between the portfolio and the benchmark. X post alpha is actual and historical, which is simply the average of residual returns over period. It can be positive or negative, and we can build a regression model to calculate X post alpha. Okay, so you please write down this particular equation. This RPT is excess return on portfolio, which would be calculated as return on the portfolio minus return on the minus RFR, and this RBT is excess return on benchmark, and this is your residual return. Okay, so it looks like a really fancy formula, but it has got very straightforward meaning. Now let me rewrite this equation here. Excess return on the portfolio is equal to alpha plus beta multiplied with excess return on the benchmark plus a random term or random error term. This regression equation in a way would produce the same results if you're dealing with a single time period data, which otherwise CAPM equation will produce for you. For example, let us say return on a portfolio has been 20%. Beta of that portfolio was 3. Risk-free rate of return is 8%, and return on markets are 10%. Okay, so if you plot this in equation, in fact without plotting it, tell me what should be the cost of equity using the CAPM model. We have equity risk premium of 2, so 2 into 3 is 6. So we are looking at cost of equity of 14%, which means alpha in this scenario, since we've been able to generate 20, alpha should be how much? 6%. Now if you put the same numbers into this equation, excess return on the portfolio, so 20% is the return on portfolio, but excess means how much over and above RFR. RFR in this case was 8, so excess return on the portfolio would be 12%, is equal to, let's keep alpha on hold, beta is how much? 3, and how much is the excess return on the benchmark? So return on market is 10, RFR is 8, that means excess return on the benchmark is 2. So this value becomes 6. So to satisfy this equation, value of alpha should be how much? 6. But once we have understood that we can extrapolate the alpha using this equation, we can use this regression methodology on historical data for multiple years. For example, if you have data like this, we have returns on portfolio P, 25, 30, 35, 20, 25, returns on benchmark. We have RFR. Then we can calculate excess returns on P, which would be 25 minus 10, 15, 30 minus 10, 20. In the same fashion, we can calculate excess return on benchmark, which would be 12 minus 10, 2, 15 minus 10, 5. Now we can plot a graph. So on our graph, let me do it here. On x-axis, we will have excess return on benchmark. On y-axis, we will have excess return on portfolio, and it would give us a regression line like this. The slope of this line is nothing but beta of that stock. Sensitivity of returns on that portfolio manager vis-a-vis the returns on the benchmark. But intercept is the alpha, that irrespective of that beta, you would still be able to earn an excess return here. Correct? So let's put these values in your financial calculator. Say second 7, return on portfolio P should be Y values. So make these as Y values. And return on benchmark should be the X values. Return on benchmark should be inserted into the data function as X, return on portfolio as Y. Data function, we have to use second and 7 on the Texas Instrument calculator. And to get into the stat function, once we've inserted data, then we press second and 8 and solve for A and B. Okay, so when you keep on pressing downward arrow, it will give you value of A and B. A is how much? 12.31 and B is 0.73. So we have an equation like this, that we can forecast excess return on portfolio, which is equal to 12.31 plus a beta of 0.73 into excess return on the benchmark, plus there would be a random error term. And this 12.31 is the alpha of that particular portfolio manager, which is same as residual return. Are we good to go ahead? Next concept is, how do you calculate alpha of a portfolio? A portfolio alpha is simply the weighted average of its individual securities alpha. Okay. And by definition, what should be the alpha of a benchmark portfolio? Alpha of benchmark should be how much? 0. A benchmark will always have an alpha of 0. Why? Because it is the benchmark with which you are going to compare. So if benchmark is 20, then minimum expected is 20, and therefore benchmark is always going to have an alpha of 0. X anti-alpha is forward looking. X anti-alpha is always positive. X anti is forecasted alpha. Alpha of a portfolio is simply the weighted average. Alpha of a benchmark portfolio by definition has to be 0. Now we'll look at an example here. Let us say we have a portfolio which is made of 4 stocks, stock A, B, C, D. For each of the stock we have an alpha. Now one thing that you would observe is that if you take total of these alphas, it has to come to 0. Why does it have to come to 0? Because imagine that the return on the entire portfolio, so it works like this. Let us say you have security A, B, C and D, and we have some return on this. Okay, so let me make up an example. Let's say this is 10%, this is 12%, this is 8%, and this is 10%. Now these are the returns we've been able to earn. These are weights. So let me keep them as an equal weighted portfolio here for simplicity. 25%, 25% and 25%. If this is your benchmark, we can calculate a weighted average return we've earned on the benchmark. And how much is the weighted average return? Weighted average return is 10%. That means benchmark has been able to generate a return of 10. So we can calculate alpha for an individual security. So security return was 10 and the average return was 10. So here alpha is 0. But here alpha would be positive 2. This would be minus 2. This would be 0. Total of all of these would always be 0 because this is nothing but summation of x minus x bar. Is that fine? So we have alphas of these portfolios. We have benchmark weight. We have portfolio X weight, portfolio Y weight. We have been asked to calculate the active weight of portfolio X. And how would we do it? We will say benchmark was 25, but this portfolio manager decided to put extra 5%. Therefore, active weight here is plus 5. But here he decided to put lesser 5%. So here active weight would be minus 5. In the same fashion, plus 5 and minus 5. Now let us calculate the alpha of portfolio X. Alpha of portfolio X we can calculate from two possible perspectives or two possible ways. First, we can use these weights and we can calculate a weighted average. So it would be 2.5 into 30% plus, please do this with me, minus 3 into 20% plus 1.75 into 30% plus minus 1.25 into 20%, just a weighted average, 0.425. So the alpha of portfolio X, which is a weighted average, is coming out to be 0.425. You got the same value, Justin? Okay. Now the same alpha we can also calculate. Instead of using total weights, we can just use the active weights. The answer would be same. So let us experiment and see if it fetches us the results. So in this case, your active weight is 5. So we will say 2.5 into 5% plus minus, so let me just rewrite the whole thing separately, 2.5 into 5% plus minus 3 into minus 5% plus 1.75 into 5% plus minus 1.25 into minus 5%. So this is 0.125, this is 0.15, 0.875, 0.062, and total of that would be again 0.425. Are my calculations correct? Okay. So then, if you want to calculate alpha for portfolio, you can either use the total weights into the individual securities alpha, or you can simply use the active weights. Now, one interesting thing here is, we know that active weights were 5, minus 5, plus 5 and minus 5. If you observe the active weights of Y, 25 and 35, active weight here is 10%, minus 10, plus 10% and minus 10%. And since your active weights are exactly double, your alpha is going to be double, since we'll have a multiplication factor of 2. So if this was 0.425, then this has to be it would be 0.85. Are we fine here? Let's do one more example. Now, first thing we will check is that is this totaling to 0? In this example, it is not. Okay, so it's a wrong example. 3.5 plus 1.5, this should be 5 minus 4.5. So we will make this value as minus 0.5. Is that matching now? Yes. Correct. And now calculate simply the alpha of security X. So 3.5 into the active weight of 5% minus 4.5 into minus 5%, 1.5 into 5% and minus 0.5 into minus 5%, 0.5. Is it same? Okay. So then alpha of portfolio X would be 0.5. And can we observe that portfolio Y weights, portfolio Y has double the active weights of portfolio X. If this was 5, this was 10. If this is -5, this would be -10. Again, this is +5, +10, -5, -10, and therefore alpha of portfolio Y should be 1%. Moving further. Then next formula that you would want to remember for the exams, that we can calculate the alpha from the t statistic of the intercept of the regression. Okay, for example, we have learned that excess return on portfolio P is equal to alpha plus beta into excess return on the benchmark. Now this alpha is nothing but the intercept, and in quant we have learned that when we generate an ANOVA table, any statistical software will generate an intercept. It will also generate a standard error for the intercept. Now what if we have to perform a significance hypothesis test for the intercept? Then the formula would be whatever is the intercept you would calculate it, so t stat is equal to whatever intercept you've calculated divided by standard error. So it is actually intercept minus hypothesized value, but since hypothesized value is 0, we will simply say intercept divided by standard error. And the formula which is given for information ratio is that we will take information ratio is equal to t stat of the intercept divided by root n. T stat of the intercept divided by root n. Now there are two possible scenarios on the exam. Number one, they will give you this data. They will give you the intercept, they will give you the standard error and n, and you will be required to calculate information ratio. Or there would be a statement on this formula. So you might come across a statement which says that information ratio can be calculated by dividing the t stat of the intercept with n, and then you would say it's an incorrect statement because it should be divided by root n. Okay, so just remember this formula. So the first formula that we saw for alpha was annualized residual return divided by risk, which was simply alpha divided by omega, or t statistic of the intercept divided by root of n. Are we good to go ahead now? Let's do a practice question. Regressing mean excess return on a particular security against the excess return on benchmark for 18 years produced following results. We have alpha, so this is a standard regression equation. The intercept is 3%. RBT, that means the slope coefficient, is 1.01. We've been given a standard error of 2%. Calculate ex post information ratio. So first step that you will do is you would calculate a t statistic of the intercept. T statistic of the intercept would be the alpha divided by standard error, right, which is the intercept divided by standard error. So that would be 3% divided by 2%. So we have a t stat of 1.5. And then step number 2, information ratio is equal to t stat divided by root n. So 1.5 divided by root of 18, because we've taken 18 years of data, and then that would give us an information ratio of 0.35. Is it easy? Okay. Now this is interesting. Let us say on the exam they tell you that we have an information ratio which has been calculated as quarterly residual return quarterly residual return divided by quarterly residual risk. And let us say this ratio has been given to you as 0.25. And then they will ask you that what should be the annual information ratio. So this is a quarterly information ratio. Now what you would say is it seems like a slope, isn't it? You're dividing A with B. So if you take it as an annual ratio, then there would be a multiplication factor of 4 in the numerator, 4 in the denominator. The ratio ideally should remain constant. But it does not work that way. And the intuition here is that annual residual return would be 4 times of quarterly residual return. So the numerator we will multiply with 4. But if you want to convert an quarterly standard deviation to an annual standard deviation, we multiply with the root of 4. Okay, if you have a daily standard deviation and if you want to convert that to an annual standard deviation, assuming 252 working days in a year, then you will say annual standard deviation is equal to daily standard deviation into root of 252. Why? Because the multiplication happens on the variance level. So on the standard deviation level we take root of that value, which means annual standard deviation would actually be 2 times higher than the quarterly standard deviation, which means the conclusion that information ratio can increase with time period. So compared to a monthly ratio, quarterly ratio would be higher. Compared to a quarterly ratio, annual information ratio is going to be higher. So if we have a quarterly information ratio of 0.8, what should be the annual ratio? 0.8 multiplied with 4 by root 4, which would give us 1.6, sorry. This would be 1.6. Okay. So just write down this sentence, these two in fact. First, quarterly information ratio is half of annual information ratio. Okay, all these are testable in a theory case study pattern. And second, information ratio will increase with the time horizon. Moving on further. Let's do some practice questions now. A manager can achieve expected residual return of 3% with a residual risk of 7.5. Given the risk tolerance of a particular investor of 8%, what should be the return? So it's a really straightforward concept. Once with this data, we will calculate information ratio of the manager. And information ratio of the manager would be 3 divided by 7.5, which would be 0.4. And we know that this information ratio remains constant irrespective of what is the risk you take. So if you take a risk of 1, so let me say omega. If you take a risk of 1, then you are looking at alpha of 0.4. If you take a risk of 2, you would get alpha of 0.8. If you take a risk of 8, you would get alpha of 3.2. Risk of 10 will produce an alpha of 4. So in this question, if we have a risk tolerance of 8%, then the residual return that we are looking at is 3.2%. Okay, so which gives us the formula, and the formula is alpha is equal to information ratio into omega. Alpha is the residual return. This is information ratio, and omega is the residual risk. One more question. A manager can achieve a return of 5 with a residual risk of 10. What's his information ratio? 0.5. So if there's a risk tolerance of 8, then the residual return would be 4. A manager can achieve 2.5 with 5. That means again we have a information of 0.5. So with 8 again he can earn 4. And a sentence that manager's level of aggression does not affect her information ratio. Now, which means if we call this manager as manager A and this manager as manager B. Since manager A has a risk of 10, it appears to be a more aggressive manager. But then, irrespective of how aggressive a manager is, the information ratio would purely be a function of skill and the number of coverage of the stocks that manager is going to take. So the level of aggression is not going to affect the information ratio. Are we fine? So what if we decide to put this on a graph? On x-axis we put the residual risk, which is omega. On y-axis we put the residual return, which is alpha. If there is a risk of 3, we are looking at residual return of 6. If there is a risk of 6, we are looking at a residual return of 12. A risk of 9, residual return of 18. So when you plot this relationship onto a graph, the straight line that you get, it would be called as residual frontier. This particular point of residual frontier is nothing but the benchmark portfolio, because in this case we have residual risk of 0 and we have a residual return of 0, and the slope of this particular line would be called as the information ratio. So residual frontier, slope of residual frontier is information ratio. A higher information ratio means steeper residual frontier. So imagine if you have a information ratio of 0.2, then you'd have, for one risk you would have increase of only 0.2. But if you have an information ratio of 0.5, it would be more steeper. Information ratio of 1 would be like this, 2 would be somewhat like this. That means higher the information ratio, we will have more steeper residual frontier.